As dawn broke over Wall Street on a seemingly ordinary Monday, the news struck like a bolt of lightning. First Republic Bank had capitulated under the overwhelming weight of withdrawals, marking one of the most significant bank collapses since the 2008 financial crisis. This event was not just a failure of a financial institution. It was a harbinger of potential economic turmoil, reflecting deep, systemic vulnerabilities within the American financial landscape. As investors, policymakers, and the public scrambled to gauge the implications, a chilling question arose. Was this the first domino to fall in a sequence that could lead to a full-blown economic crisis? This question was not born of paranoia, but from a series of observable tremors that had been disrupting the foundations of financial stability in preceding months. The collapse of First Republic Bank, once considered a robust pillar in the banking community, was a stark manifestation of the latent risks accumulating like fault lines beneath the surface of the US economic terrain. The collapse of First Republic Bank was not an overnight development. This catastrophic event was the culmination of a complex interplay of overexposure to high-risk mortgages, aggressive growth strategies, and the sudden loss of depositor confidence. As the news broke out, visual media depicted the stark drop in the bank's stock price, a clear indicator of declining confidence. Investors and savers alike began a frenzied dash to withdraw their assets, which, in a self-fulfilling prophecy, hastened the bank's demise. This chain reaction underscores a critical vulnerability in the bank's strategy, an over-reliance on volatile, high-net-worth deposits, which, while profitable during stable times, proved catastrophic in a climate of fear and uncertainty. In the hours following the collapse, the ripple effects were palpable across financial markets. Stock indices dipped, reflecting an immediate response from an edgy market, while safer assets like treasury bonds saw a surge in interest, signaling a flight to safety among investors. Regulatory bodies, primarily the Federal Reserve and the FDIC, were quick to respond, aiming to quell the panic by reassuring the public of the robustness of the financial system. Statements were made, press conferences held, and measures were implemented swiftly. The broader implications, however, painted a grimmer picture. Analysts and economists started to revisit their forecasts, pondering whether other financial institutions might be silently wrestling with similar issues. The fall of First Republic was not an isolated incident, but a symptom of broader systemic issues affecting smaller and mid-sized banks across the nation. The immediate fear was the onset of a contagion effect, wherein the mistrust in one bank could lead to a generalized mistrust in similar financial entities. Long queues outside other smaller banks, reminiscent of the distressing days of the 2008 financial crisis, began forming as depositors raced to secure their funds, fearing their own banks might be next. This part of the narrative examines how closely interconnected our financial institutions are, and how the failure of one can instigate widespread panic and potential failures of others, thereby amplifying the initial shock into a systemic crisis. The sector perhaps most reflective of the reverberations of First Republic Bank's collapse is the housing market. Historically, the sector most sensitive to shifts in banking confidence, the housing market's reaction was both swift and severe. Mortgage rates, initially stable, began their ascent as lenders reacted to the increased risk, making borrowing more expensive. This, in turn, slowed down home buying, started affecting home prices, and increased fears of a downturn in the housing market, which could have far-reaching consequences on consumer wealth and overall economic health. Our analysis here delves into the statistics and expert opinions, drawing a clearer picture of how intertwined the health of banks and the real estate market really are. The psychological impact of a major bank collapse cannot be overstated. Consumer confidence, a critical component of economic stability and growth, took an immediate hit. Surveys post-collapse indicated a steep decline in consumer sentiment, which traditionally presages curtailed spending and decreased economic activity. This graph illustrates a notable dip in the Consumer Confidence Index immediately following the bank's collapse, reflecting widespread anxiety and uncertainty about the financial system's stability. This section explores how diminished consumer confidence translates into reduced economic activity, perpetuating a negative feedback loop that could exacerbate the initial economic shock. The specter of nationwide bank runs is a scenario that no one wants to contemplate, yet the events following First Republic's collapse made this a topic of legitimate concern. This section evaluates the risk factors and preventative measures in place, exploring the potential scenarios where a panic could escalate into widespread bank runs. Discussion revolves around liquidity reserves, depositor insurance limits, and the psychological factors driving public perception and actions in times of banking crises. In the wake of the collapse, it was commendable how swiftly financial governing bodies intervened to prevent further deterioration. Policy responses included emergency measures to shore up liquidity for banks deemed at risk, increased scrutiny on bank operations, and proactive communication campaigns aimed at restoring public trust. This part examines these policies in depth, assessing their adequacy and effectiveness in staving off a deeper financial crisis. Additionally, it looks at what more needs to be done to ensure longer-term stability and prevent a recurrence of similar collapses. As the dust settles on the collapse of First Republic Bank, it becomes crucial to extract key lessons and forge paths forward that reinforce the stability and trust in the US financial system. This conclusion synthesizes insights from the crisis, proposing strategic adjustments and emphasizing a vigilant, proactive approach toward regulation and oversight to forestall similar crises in the future. This crisis serves as a stern reminder of the interconnectedness of our economic systems and the need for vigilance, resilience, and proactive governance to safeguard against the vulnerabilities exposed by the collapse of First Republic Bank.